On Friday, the median ratio for stock prices of shares on mainland stock markets was 61 times that of reported earnings. That's 3 or 4 times the level in the West. So Ed first asked Peter if the downturn in stocks was inevitable. And here's what he had to say.
Well, first of all, we got plenty of stocks in the U.S. that trade at multiples higher than that. So they're not the only country that has bubbles. And, of course, there are plenty of stocks in China that don't trade at those ridiculous valuations. But sure, look, the Chinese market spiked up a few months earlier when the government relaxed restrictions on ownership. And all of a sudden, a lot of people tried to buy the same stocks at the same time. And so the prices went up, and then the buying wave went away, and the prices came back down. And, of course, people want to panic, and they want to talk about the crash. You know, the paper wealth that was wiped out in the crash only didn't even exist a few months ago. If you take a bigger look at the Chinese stock market, we're a bigger bubble in the U.S. I mean, the Chinese market is still well below where it was in 2007. And, you know, so the U.S. is a gigantic bubble. We've got a much bigger problem than China. And, in fact, the most recent declines in the U.S. are being blamed on the declines in China, when that is not the case. I think what's really hurting the markets now, not only in China, but all around the world, is the Fed. These problems are one of the few things that's actually made in America.
Well, it's interesting you would say that, because here's the thing. We all know that China's been having its problems. So why have markets reacted so violently to China's depreciation of its currency, the yuan?
Look, I think the U.S. market would be going down even if China hadn't devalued the yuan slightly against the dollar. And remember, the U.S. stock market already started to fall. I think it had fallen 6 or 7 days in a row before China devalued. So I think this is more about the Fed. Everybody believed, based on the last Fed minutes and the last non-farm payroll report, that a rate hike in September was a done deal. And I think it was the fear of the rate hike and future rate hikes that was undermining the market. Now it's very convenient to blame it on China because that's more palatable to the investor and to the financial media, so we don't have to acknowledge that these problems are homegrown and they're going to get worse. It's not simply an overreaction to something that's happening halfway around the world. What's happening halfway around the world is a reaction to what's about to happen or what everybody thinks is going to happen in Washington.
Well, I want to get to the Fed and the Fed minutes in a second, because I think that's really important. But I want to ask you about the U.S. markets, because they're up 200% from March 2009 lows. And we haven't seen one major correction since October 2011. This is the first one. That sounds like a market that was primed and ready for a pullback. No? Is that what you're saying?
Right. Well, that's because the Federal Reserve wouldn't let the market correct. Every time the market started a correction, the Fed would come to the rescue with another quantitative easing program. See, now the Fed is kind of caught with their pants down because the Fed has promised to raise rates. So how are they going to stop the market from falling when everybody is looking for an anchor rather than a life preserver? But, you know, I think the Fed is going to have to soften its rhetoric if it wants to prevent this correction from turning into a bear market, which it will if the Fed raises rates. It needs to take those rate hikes off the table. And in fact, I think they're going to have to go with QE4 in order to stop the stock market from going into a bear market. And I think we would eradicate most of the gains since 2009 because all of those gains were fabricated by the Fed. It wasn't because of real improvements in the fundamental values of U.S. businesses. It was all about financial engineering. It was about cheap money, quantitative easing, share buybacks, all while the U.S. economy continued to deteriorate beneath the surface of all those bubbles.
Now the Fed's July minutes came out, as you were talking about, but they actually turned out to be a lot more dovish than a lot of people anticipated. So, like, if you look at market measures, they show that traders are backing away from a prediction that the Fed would actually raise rates in September. Are you surprised by that?
Well, I thought the remarks, the minutes were very dovish. I was expecting dovish minutes because I've been saying all year that the Fed has no intention of raising rates, that the whole thing was a bluff. I was surprised that so many people read those minutes and actually thought the Fed was getting ready to raise rates, although some people did say, okay, we don't think they're going to raise rates in September, but they're going to do it in December. But they're not going to do it in December either. I mean, nothing's going to change between September and December. If the Fed can't raise rates now, they can't raise them in December. In fact, why didn't they raise rates 2 or 3 years ago? The U.S. economy was in better shape 2 or 3 years ago. Why didn't they raise them back then? Because had they raised them back then, they would have precipitated a recession then. They would have caused a bear market then. We've been living off the Fed. And in fact, there were 2 supports, quantitative easing and 0% interest rates. They've already removed one. That's why the markets aren't going up anymore. But if they remove the other, there'll be nothing to support them at all but hot air, and the markets will just implode.
That's interesting that you would say that. We only have time for one more question because I'm going to ask you about this, QE. I want to talk about QE for a second here. Quantitative easing, obviously, where the Fed buys assets with newly created money. That's back in the headlines because Atlanta Fed President Dennis Lockhart said he wants to raise interest rates this year, but he puzzlingly said that he would. He added that the Fed could raise rates and still add liquidity via QE, bring QE back even though it's raising rates. I thought that was a bit of a head scratcher, but you know, hedge fund guru Ray Dalio and also Larry Summers, they're on the QE bandwagon. They say that this is where it's headed. Do you think that that's where it's headed?
Yeah, I don't see how they step on the gas and the brakes simultaneously, so it doesn't make sense that they would be able to do that. But I'm not on the QE bandwagon, and I think it's a good thing. I just think that they're going to do it. It's the wrong thing, right? It's more of the same toxic medicine that made the economy so sick. But that is what they are going to do. They're not going to admit that QE 3, 2, and 1 were all mistakes. So they're going to do QE 4 because they're going to refuse to acknowledge their mistakes or accept responsibility for what's happened. You know, everybody thinks that QE was a success. It was a complete failure. You know, the measure of success is not launching these programs. It's ending them, right? Anybody can cut interest rates and bring them to zero. The trick is to raise them back up again. Anybody can blow the balance sheet up to $4.5 trillion. The hard part is shrinking it back down, right? Anybody can start taking drugs. It's easy to start a drug habit. Just start taking drugs. The hard part is once you're an addict, how do you quit? How do you give it up? That's where the pain comes in. So we can't kick this bad habit of cheap money and QE unless we're willing to go through a painful withdrawal that's going to be in the form of another financial crisis that'll be worse than 2008. And the Fed doesn't want any part of that. So that's why we're going to have QE4. It's because the Fed doesn't want to admit its mistakes and is afraid to deal with the consequences. And so ultimately we're going to have to suffer something worse, which is going to be a dollar crisis. And right now everybody is worried about the strong dollar. Well, the real threat is going to be the weak dollar because it's going to get really, really weak very fast.
All right, time now for a quick break, but stick around because when we return, we'll talk about Apple's CEO releasing some very sensitive information to a TV journalist. Might that put him in hot water with the SEC? We'll tell you coming right up. Then in today's Big Deal, Ed Harrison and I are talking about the event that everyone calls Fed Camp. What's it all about and what might it tell us about the global economy of the future? We'll take a look at that on the other side, so stay with us. And as we go to break, here are the closing numbers.